You might not need an annuity. Not everyone needs an annuity. With the market in turmoil, interest rates up, but your retirement portfolio and safe bond funds down, should you be considering sheltering some of that hard-earned income and assets into an annuity? It's a question I'm sure some of your financial planners or insurance agents have asked you. As I approach 39 this year, I asked myself that question: should I be looking at an annuity as well? But should you? In this video, I go over 16 questions to help us better understand annuities and whether or not we should buy one for ourselves. And hopefully by the end, we better understand these mysterious and not well understood financial tools. Number one, what is an annuity? Once upon a time, there was this special agreement called an annuity. This agreement was made between a person and an insurance company to help this person reach particular goals. These goals included keeping the money safe and providing a stream of income for when this person got old and when they needed it because they no longer worked. Now, annuities might sound like these magical treasure chests, but they're more like contracts or a special promise between the insurance company, that magical company, and that special person. Now, both the insurance company and the person have rules that they have to follow in order for these promises to be kept. Now, if these promises are not kept, there can be big problems. Annuities can be tricky. So let's think of them as a friend we all know, Social Security. Just like Social Security gives people money every year when they're older, annuities do the same thing. But not all annuities are the same. But we'll get into that a little later. Number two, is buying an annuity a good investment? Annuities have one special component when it comes to the land of retirement planning that very little people actually talk about. And I'm not sure if it's some idea that's going to get twisted into some very bad sales practice, or it's just something that the industry shies away from. And that's annuities have no cap on how much you can contribute. 401ks, 403bs, and IRAs all have an annual max, meaning you can put more than X amount of dollars into your retirement vehicle. But annuities have no cap. You could literally put in as much money as you had if you wanted to buy that much. What this does is it allows you to be very, very risky when it comes to those 401k, 403b, and IRA assets because an annuity is protected. Remember, these annuity products are fixed typically if you buy the right one, and therefore you can take more risk in the investments that the IRAs, 401ks, and 403bs are in. So if you take that approach, an annuity can be a good investment when it comes to retirement planning. Now, annuities are an insurance contract and cannot be classified as an investment. But for the sake of this video and this example, yes, done the right way, an annuity can be a good investment. Number three, how do annuities work? Annuities are like a special kind of insurance that helps people feel safe about their money. The person who owns an annuity is called the annuitant. They make a deal with the insurance company to take care of their money. Now, the annuitant gives money, which we call premiums. I'm sure you folks are familiar with the term premium. It's what you usually pay the insurance company when you buy insurance, an insurance premium. Now, that premium is given to the insurance company either in a lump sum, meaning all at once, or throughout certain periods. And that premium is then collected by the insurance company and kept safe. Now, during the period that it is kept safe, we call this the accumulation period, where your money is growing and you're saving this money to accumulate for something. Think about it like you're saving for a particular item that you want to buy in the future, in this case, your retirement. Now, what's very different from insurance is when you buy insurance, you typically are buying protection from something. When you are buying an annuity, you are buying a future stream of income. So unlike insurance, where you never get to see those premiums again, with an annuity, when you turn on an annuity and you annuitize it, you are actually receiving all of those premiums back with sometimes some interest, sometimes, depending on the contract, something else. So that is what the key difference in how annuities work differently from insurance. Now, depending on the kind of payout you choose, annuities can actually pay you out every month, every quarter, every 6 months, every year. They can also pay you back all at once. It really just depends on the type of payout structure you pick. They can also pay you out for the rest of your life. They can pay you out for the rest of you and your spouse's life. They can pay you out for a period certain, 5, 10, 15, 20 years. Or they can pay you out for a lifetime and a period certain. It really depends on how you want to structure that payout. But it's going to, again, change the amount you receive as well. So these are things that you have to really think about when structuring how to get this payout. Number 4, what are the differences between life insurance and an annuity? So as I briefly mentioned before, with life insurance or any kind of insurance, when you pay a premium, you are receiving protection. When you are buying an annuity, you are receiving a future income stream. Number 5, what are the different types of annuities? Well, there are 2 really different classifications of annuity. There is an immediate annuity and a deferred annuity. Let's take a look at our friend, the immediate annuity first. An immediate annuity is probably what most people are kind of familiar with when they're thinking about annuities, because that's kind of what I think about anyway. An immediate annuity is what happens when you pretty much say, I'm going to collect my pension. Or if you worked for a union, you say, I'm going to collect my annuity. You're pretty much annuitizing something, and you are turning a lump sum of cash, call it $1 million, into a lifelong monthly or annual payment of money that never runs out. And that's what an immediate annuity is. Very simple, straightforward. They do a calculation based on what the interest rate is today, how long you have to live, and whether you're a male or female typically. Now, the other classification of annuity is a deferred annuity. Now, this guy's a little more complicated. This friend of ours, the deferred annuity, is where you take money, whether a lump sum or over a period of time, you accumulate money. And our deferred friend actually has 3 more subcategories. Our deferred friend, he's a gardener, and he has 3 gardens where he can put his money that he gets from you, the premiums, into. Now, as a gardener, he has 3 different gardens that he can put this money in. Now, our deferred friend, for you risk-averse folks out there, he has fixed gardens where you get a fixed amount of return every year based on what current interest rate environment is like. This is called a fixed annuity. Usually these things have a period, 1 to perhaps 7 years, where during this term, your interest rate is guaranteed. And after that, it'll probably fluctuate whatever the current interest rate is. And if you want to renew, you can renew it at the renewal date, 1 to 7 years in the future. Now that's for you very risk-averse folks. The next level, the next garden, is going to be the fixed index annuity. Now, fixed index annuity, they have a fixed component where you are receiving a participation between what a particular index receives and 0. So you can never go below 0, but you only get up to a certain amount in participation of some index. It could be a popular index like the S&P 500, or it could be some made-up index that the insurance company created for this particular annuity. And the most aggressive garden that this deferred friend can put our money into is the variable. Now, the variable annuity is very much like putting it in a mutual fund. And these annuities, to me, speaking very plainly, is a waste of money. In a variable annuity, you're pretty much putting your money into a very expensive vehicle and then buying very expensive investment vehicles inside of that vehicle. And you're limiting yourself because you are only able to access the investment vehicles inside of the larger variable annuity. You can't buy everything. You can only buy pretty much what's in here. And that really limits you to your investment choices, as well as pretty much all the fees you have to pay, because you're paying the broader variable annuity fee and then all the investment fees within it. And typically, those fees can be quite high, and annuities come with their own problems as well, as we'll see further as we move along these list of questions. Number 6, how do fixed annuities work? Well, fixed annuities work in a particular time period. Call it 5 years. If you buy a fixed annuity and it has a 5-year period, during the 5 years, if it pays 5%, you will get a guaranteed rate of 5% per year for those 5 years. At the end of those 5 years, you will get to cash out of your annuity and you'll pay tax at the end of those 5 years. Pretty sweet deal. Now, what about the other guy? Number 7, variable annuity. Variable annuities carry risk. So remember how I said about how the variable annuity has all those fees, inside of fees, inside of fees. In addition to those fees, you can also lose money. Now, our deferred friend and his garden, the variable annuity garden, if things go bad, unfortunately, his garden can be exposed to weather elements, it seems, because if things go bad in the market, things can go bad in the garden. And if the market has a bad year, like we had more recently, and the market drops 20-30%, your annuity value will also drop by that same amount if it is invested in funds that are or that mirror the market. So if you are looking for variable types of investments, a more suitable choice, maybe just to invest in something like an ETF or just buy stocks outright, as those things are much more efficient as far as getting that return, as you don't receive many of those benefits that you would from an annuity unless you were just trying to get the tax advantages. And the tax advantages, well, yes, if you're in a very high tax bracket and just needed the tax deferral, might make sense. Many times, talk to a CPA. There may be other ways like private placements or other types of more private and more sophisticated investments that you could utilize to actually get tax deferral and not have to buy an annuity. Number 8, annuities may have early withdrawal penalties. Annuities are very similar to their cousins, certificates of deposit. I'm sure many of you have heard of certificates of deposit, or CDs. Banks offer them all the time. I see billboards all the time of banks offering CDs. And CDs, if you, maybe you didn't know, if you take out the money too soon, you actually pay a penalty. Like I said before, the fixed annuity has a 5-year term. If you take out money before that, there's a penalty typically. And a lot of times that penalty can be as high as 10 or even 20%. Variable annuities typically have a 7 to 10 year, even 12-year, what we call a surrender period, where if you take out too much money, you get penalized. Now, there is what's called a surrender-free withdrawal amount, and that's usually 10% of the initial premium paid. So if you put in $1 million, you can take out sometimes 10% or $100,000 without paying any kind of withdrawal penalty. But that is dependent on the contract. So I said it may have withdrawal penalty. There are some annuities that only have a 2-year kind of surrender or withdrawal lock, and some annuities that have a much longer 20-year withdrawal lock. So make sure you read the contract and be aware that if you put the money in there, it's not like some savings account or brokerage account where the money is really liquid, where you just have to wait, 3 days or so for the request to come through. They may have a much longer lock-in period. All right, number 9, I'm going to say this without giving any advice. Now, I'm not a tax person, but how are annuities taxed? So annuities are taxed a little bit complicated. So when you put money into an annuity, you can put money into two different kinds of annuities. So the IRS looks at annuities in two different buckets. We have the qualified annuities. That's an annuity that you classify as like an IRA or a 401k or a 403b. That's all one classification of annuity. And then there's the non-qualified annuity. That's kind of like your regular annuity that you can buy as much as you want of. Now, for the sake of the qualified annuity, you treat this stuff like you would treat anything you put in there. So if you have a Roth annuity, all the money in there is treated like Roth money. You have a Roth, if it was a stock or if it was a ETF, if it was 401k money, all the money in there is subject to tax at whatever rate it is when you pull it out of there. That's how that works. Now, the non-qualified, so this is the part that can be kind of funny. So non-qualified annuities are taxed when they are taken out. And if you are to take out all the money at once, remember, some of the money in there is already taxed, while the growth above what you put in, the premium you put in, that part is not yet taxed. So this part, the growth part, is taxed at the ordinary income level. Now, what happens if you annuitize? What happens if you decide to not take all of it out at once, but you decide to take this amount out throughout your entire life? Well, then you have to calculate what's called the exclusion ratio. That means how much of each annual payment is a return of premium, meaning how much of it is this, and how much of it is the interest that you receive. And then on the interest you receive, you pay ordinary income tax on. And that's how annuities are taxed. One quick kind of insert though, if you're taking these things out before you're 59 and a half, you may be subject to what's called early withdrawal. Now, because these are tax-deferred items, they are meant for retirement, you have to pay 10% early withdrawal penalty if you take it out too soon. Number 10, and this is kind of a segue into what I'm about the agents and professionals. Annuities have fees and annuities have commissions. All right, typically annuities have fees somewhere in the 2.5% to 3% range. And these fees are in the variable side. Fees have what's called a mortality and expense fee when there are variable annuities. This fee is to guarantee the premium that is paid. So all annuities, in order to be classified as an annuity, all premiums are guaranteed. And in a variable annuity, if you pass away before you start turning on your annuity, all those premiums have to be paid out to your beneficiary. And if the stock market drops 50% and you paid in $1 million, your account value's half of that, but the insurance company is responsible to give your beneficiary $1 million. And that M&E fee can be as high as 2.5–3%. Now, in my experience, I've seen them usually hang around 1.2 to 1.5%, but they can be much higher and they can grow if the insurance company is kind of not doing that good. So commissions, as an agent, I've seen commissions as low as 0.25% and as high as 7.5%. And typically the range has to do with how long the annuity surrender period is and how complicated the annuity is. For example, if it's a fixed annuity that's maybe 1 year, the commission is probably at 0.25%. If it is a 12-year long surrender with, and it's a fixed index annuity or a variable annuity, oh yeah, that commission is going to be 7.5%. So on $1 million contract, your agent's going to be making $75,000. That's a pretty hefty chunk of change for $1 million annuity. Now, not many people, I've never sold $1 million contract in my, when I was a financial planner or an agent, but I'm sure people do. I mean, I've seen email where tons of people are saying how many they sold, a lot. But, that is a lot of money. It's a lot to consider when you're talking to somebody who has dollar signs, in their eyeballs when they're talking to you. So it's something to consider and think about But don't let that get in the way with what you're trying to do. So one of the things that you can do to really solidify what you're getting out of the annuity and that the agent or financial planner has your best interests at heart is to write down in your own words why you are buying this annuity, how it's going to help you, and why you think it's important for you to do it with the amount of money that you have, and how it's going to help you. It's, for example, I need to buy this annuity now because it's going to provide for me the essential living expenses like my rent, my food expenditures for the foreseeable future. Because if I don't do this now, the market could eat away at my assets. Or I need this to supplement my Social Security income because currently I don't have enough and my assets may not be enough, or I may outlive my assets. And have that in writing, have your financial planner sign that to acknowledge that is why you're doing that. That way you can kind of negate any negligent sales practice or negative sales practice when it comes to annuities. Because a lot of people may think that their advisor is trying to sell them something when actually the advisor is trying to just put something in there that works for them. I've sold these before, and I can tell you that whenever I did, it was to help somebody, not so that I could make more money or anything like that. So just remember, a lot of times when you're sitting down with an agent or your financial planner, they're not trying to sell you something when it comes to an annuity. They're really trying to find the best fit. And if it's really not the best fit, it's not because they're trying to make more money. It's because when you're answering the question of, what is this for? How's it going to help me? Why do I need this? Those questions can't be answered by you in your own words. And if that's the case, you need to either have a longer, deeper, more meaningful conversation with that person, your advisor, or it's not that important. Number 11, index annuities are not the best of both worlds. I have been subject to this misnomer, problem, fallacy too. Index annuities many times are advertised as the best thing in the world because zero is your hero, you can't lose any money, etc. Now, the way index annuities work is they track the performance of a particular index. Now, here's the problem. Many of these annuities are set up to be what we call point-to-point. Now, point-to-point means that they would track an index from one date to another date. And we're going to do it this way because that's how time works. It moves this way. And if there is increase between this point and this point, you get credited. If there's no increase between this point and this point, no credit. So let's think about this. So if we move from here to here, and it goes up and down and up and down and up, but we don't get any increase when we reach here, but it went up and down, and it went up, substantially up, but we never got that when it came here, then we don't get anything. So even if the market was rallied all the way up 10-20% during this time period, but not in the time period that we needed it, we didn't get anything. Additionally, we don't get any dividends typically. And if you watch, or if you follow my other channel where I talk about dividend investing and how awesome that is, you don't get any dividends either. So there's pretty alarming problems there. So index annuities aren't the best of both worlds. They're a kind of a compromise between getting a fixed rate or participating in the kind of appreciation of an index value. And that's what you kind of have to understand when you're dealing with fixed index annuities. Number 12, riders. How do riders provide value? Now, most riders attached to annuities are not free. And if they say they're free, many times they have some baked-in cost. And usually the riders that are in there that have a baked-in cost are taking away from things that potentially could be valuable to you. That's just how it works. Now, the most common riders are two of them. They are living benefit riders and death benefit riders. Now, how do each one of them work? All right, so living benefit riders on an annuity will give you access to income typically. So remember how our deferred friend, right? This is all deferred annuity talk. Our deferred annuity friend, if you would have purchased a deferred annuity, you could have an income rider where you're building up your income potential with an income rider. Now, as the income potential grows, that income potential cost could be taken away from the cash value. So in the beginning, it could look like this, where the cash value and the income potential is $1 million. And then you have an income rider where every year, no matter what happens, your income potential goes up 10%. But it costs you your cash value. If you were to say, insurance company, I don't want this annuity anymore, I just want all my money back, that value could be eaten away at 1% per year. So after 10 years, it could look like this. Your income potential now is real high, but your cash value went down by 10%. And if the market didn't do anything, it could be even lower, right? Depending on what kind of annuity contract you've got. Variable could be even lower, but fixed, it might just be below what you had. And that's what I mean by it could cost something. It's not free. And then the annuity company is almost certain that you're not going to cash this thing in. You're going to turn on the income. And that's exactly what they want, because they don't want you cashing this thing out. Annuity insurance companies, they want you to take the annuitized version because they want you to take out money slowly, because the longer you have the annuity with them, the higher chance that they will be able to make money. But what about the other side? What about the death benefit riders? They can't make money on there, can't they? Well, yes, they can. So on the death benefit side, same way, except there isn't an income rider, there's a death benefit rider. So say $1 million example, take $1 million, cash value, death benefit. So every year, 1% goes down on the cash, and then every year, 10% goes up on the death benefit. So now let's say you had this thing for 20 years, 80% value, 200% death benefit value, right? You are not going to cash this thing in, even if you really, really needed to. And if you really, really needed to, the annuity company would be more than happy to give you 80% of what you had over the 20 years versus now potentially giving you 200% in a couple of years. Because if you're 85 or so, that would be a great risk to be released of if you're the insurance company. So that's kind of how they work. They're not free. And the more you kind of ride it out, these riders, the more beneficial it is for the insurance company from a risk perspective. It may be better for you from like a income or a death benefit perspective, but for the insurance company and on a risk kind of adjusted basis, they're always in the clear, and they have to be, because insurance contracts are written in a way or are governed in a way that once it's signed, it's always going to benefit the insured or the annuitant, which is the person like you and me who are buying these things. So it has to be tailored in a way that it will always benefit the insurance company once we sign. Number 13. Lucky number 13. Now, what happens to the premiums if we die too soon? Fitting, right? All right, so remember I said briefly about the return of premium riders or return of premium protection. So in all of the deferred type annuities, there's what's called a return of premium protection. That's easy. But what about the immediate annuities? So immediate annuities are the ones where we kind of just annuitize everything, right? It's like Social Security. You turn it on and boom, all of a sudden, unlimited income as long as we survive. But that's the thing, as long as we survive. So one of the most frustrating things about these single life annuity contracts is that if you pass away, all the money disappears and goes to the insurance company. And these insurance companies, they know that. And that's why they can pay out lifetime income. Because for every person who passes too soon, there is that one lucky or two lucky individuals who live longer. And the people who pass too soon fund the people who live a little bit longer. So be thankful and thoughtful. Know that if you know someone who paid or passed too soon with a lifelong annuity, they are helping someone achieve their dreams in their longer term retirement. Number 14, we're almost there, guys. Guarantees are not guarantees because it's the insurance company who's guaranteeing it. If you've ever seen the movie Too Big to Fail, if you haven't, I recommend seeing it. I'll leave the link in the description below. William Hurt plays our U.S. Secretary at the time during the Bush administration in 2008. And he talks about how the banks, if they fail, teachers could lose their pensions, firefighters, most of the U.S. will lose their pensions if all these banks fail because all these banks bought all these CDOs and mortgage-backed securities. And yeah, that actually could happen because pensions are annuities, right? So if these annuities fail, then your pensions could be gone. So one of the things you have to think about when you're buying an annuity is to look at the ratings. So here are the rating kind of organizations, and you want these insurance companies you're buying from to rank high. Another good screener is if you've never heard of the insurance company before, probably not a good idea. Also, if the insurance agent who's selling it to you doesn't seem to know too much about this company either, or hasn't sold any of these contracts before, it may not be a good sign either. Now, personally, I've had a client who had an insurance annuity contract that was sold to their father in the 80s, pass insurance hands 4 times, probably more by now, I'm not sure. But the insurance contract was great, never revised, always had the same terms. So as long as pretty much the kind of state of insurance laws remain the same, where the state itself that you live in has to remain solvent, and whenever an insurance company fails, the remaining insurance companies that operate in the state have to buy the existing contracts of the failed insurance company, then you're pretty much okay. But still, you don't want to have to keep calling different people to figure out who owns your insurance contracts or annuity contracts. So stick to the big players. If you haven't heard of them, steer clear. And if your agent doesn't seem too knowledgeable about this company, other way as well. Number 15, how to choose the annuity provider. Kind of talked about it in the other step, but yeah, look for low fees and from companies that you know and trust, and dig a little deeper with that insurance agent. Last one, number 16. Not everybody needs an annuity. Warren Buffett does not need an annuity. He has surpassed the normal life expectancy for a U.S. citizen. He has more than enough money to provide for him everything he needs. He does not need a lifelong income. He gets more money from Coca-Cola through dividends than Coca-Cola CEO gets from salary and options. So those folks don't need annuities. Also, if you think you're not going to outlive your money, you don't need an annuity. But with that said, annuities can provide a reliable source of lifelong income. And if that's something you're concerned about, that might be a good place to put that positive energy and say, hey, I got a lifelong income that I'm going to live as long as I can to collect. And I'm going to end on that note of positivity. If you want to learn more about retirement topics like annuities, Medicare, or anything like that from an ex-financial planner, let me know in the comments below, and I'll see you in the next video.